watching Daybreak Asia, coming to you live from New York and Sydney.
We're counting down to the market opens in Tokyo and Seoul.
Australia has just come online. The top stories this hour. Global stocks and treasuries slip ahead of Friday's US jobs report as traders reposition on Fed rate cuts. The Nasdaq 100 logging its longest run of losses in more than a year. Apple is among the losers as it's hit with a second analyst downgrade in a week on worries about Chinese demand for iPhones. Plus, Islamic State claims it was behind the deadly bombings in Iran that threatened to further inflame regional tensions.
Well, Heidi, you mentioned Apple and the downgrade there, certainly weighing into the moves in the US session overnight, but it was that tech sector in focus. And at the start of the day, that's also the sub-index are going to be tracking quite closely. So far, we're not really seeing much movement, but of course, it is a staggered start at 9 minutes for Australian markets to be fully online. So we'll see in just a few minutes' time, really, how we see trading coming online. But futures have been indicating to a little movement as well, given, as we've been discussing across the course of this week, trading volumes in Australia are still well off their 20-day moving averages. The big moves, though, we're seeing so far are really more in the bond space this morning. We're just tracking the moves in treasuries overnight, but it is that changing or recalibration of expectations for G10 central bank monetary policy decisions over the course of this year. That's really the key focus for us, given as well we're continuing to see a fairly robust labour market in the US. So the Fed higher for longer is the key narrative here. But just as I said, equity markets so far fairly flat as we come online and really not seeing much of a move either in the tech index. But let's change on, take a look at the rest of the region in Asia today, because so far, again, as I say, that we are tracking the moves in bonds so far, and we are seeing those yields moving to the upside in the Kiwi space. The Japanese yen also a key watch for us, and we have been seeing that weakness across the course of the week, so down around 2.5% against the greenback so far. A lot of traders as well are saying that the BOJ, given the earthquake on January 1st, unlikely to pivot away from its negative policy settings anytime soon, and just continuing to track the outlook for Japanese futures as well. Given that weaker yen dynamic, we are actually seeing the Nikkei pointing to some gains, Shery, at the open.
Yeah, and that stronger dollar dynamic also really pressuring the yen, right? Because we have seen it now gain ground for a fifth consecutive session, the longest run since September. Of course, we had really treasury yields taking off in today's session, with the 10-year yield rising to almost 4%. U.S. futures coming online right now to the upside of 0.1% after drifting on the Wall Street session. We had the S&P 500 down for a fourth consecutive session. The Nasdaq 100 also down, the longest losing streak since 2022. Apple also getting another downgrade this week, and that stock being pressured, and of course investors just reacting to more economic data. The ADP report showing firms ramping up hiring in December. The jobless claims numbers coming in below estimates, not to mention the services PMI numbers for December were also revised upwards. So people have been really paring back expectations of Fed easing this week, and that's really led to that treasury sell-off today. But of course, a focus very much on the upcoming U.S. non-farm payrolls reports on Friday. Let's bring in Bloomberg's Vonnie Quinn. Vonnie, we had some indication with all of the data out today, but what are analysts thinking that we're going to get in terms of the non-farm payrolls numbers?
Right, so you can update your estimates right up until today for economists on the street, and I was having a look across the estimates, and if you look at Michael Feroli at JP Morgan, for example, he's looking for 150,000. Ian Jefferson of Pantheon, he's looking for 225,000. But the median estimate is for growth of 175,000 jobs in December. Now that's relatively healthy, right? Very healthy, I would suggest. In terms of the unemployment rate, economists are looking in the median for that to tick up just a notch from 3.7% to 3.8%. And if you look at all the data you just cited, Shery, that all points to a still very healthy job market. So I looked across some of the commentary to see what some of the economists are saying. Goldman, for example, pointing out that the mild winter that we've had in the United States, across the United States really, might actually be very beneficial to the monthly data because snowfall was minimal in the major major cities, and that would be good for industries such as construction, leisure as well, benefits from better weather. That team also pointing out that we will get some striking workers returning to the workforce in December, but that will only add to about 8,000 casino workers in the main, whereas the previous month that was 38,000. So we can sort of discount any returning striking workers for the most part. But those data points that you cited, they do give us clues. For example, the ADP data, as you said, showed that private payrolls were very healthy. We didn't get the layoffs that we thought. I'll add another one, Challenger Gray and Christmas surveys, which also give us a snapshot into private hiring, showed that there was really only 35,000 layoffs, and that if there's any weakness, it's actually in the laying off of staff, which isn't happening, as opposed to laying off staff that are already hired. So that's also a very positive data point in terms of what we might anticipate for tomorrow. And you saw it there in Treasuries trading as well. Typical pre-NFP trading pattern where Treasuries are selling off.
Vonnie, wage growth estimates, what are they suggesting?
We've been in a range, Heidi, month over month of between up 0.2 and up 0.4, really for the last couple of years, way back to August of 2022. And we're looking for something similar again, up 0.3 month over month, which would be 3.9% growth year over year. And that would be with average weekly hours unchanged at 34.4. This is a very significant data point for the Fed, but I might suggest that they will wait until the end of January for the quarterly ECI data in order to make a final decision on what actually happened with wages over the last couple of months, because that's a lot more specific when it comes to what actually happened with wages. But we have Neela Richardson, for example, of ADP saying, look, according to ADP, we're at no longer of a risk of a wage price spiral. As we know, ADP showed that the bump in wages month over month was 5.4 for those who stayed in their job, 8% for those who moved jobs.
Bloomberg's Vonnie Quinn there with the numbers. Our next guest says, despite what we've seen across the tech space and tech equities in particular, of course, it has been a pretty bad week, particularly for some members of the Magnificent Seven like Apple. And despite the big valuation gains that we've seen in the previous year, she's still constructive on the Magnificent Seven and the wider sector. Sylvia Jablonski is a CEO and CIO at Defiance ETF. So, Sylvia, we've seen a second warning when it comes to Apple, and of course, that's really taken the heat out of that stock a little bit. But you've been pretty consistent in terms of leaning into the dips for these stocks.
Yes, good evening, and thank you so much for having me. I have been consistently adding to these stocks, and I actually like when they pull back a little bit. I think that if you look at last year and you look at the NASDAQ, particularly the Mag 7, the moves have been anywhere from 50 to 250%. That sounds, great and maybe even overdone to some. But then if you go back to 2022, they absolutely had a terrible year. So, my thesis on this is that 23 was more or less the start of a recovery year for tech. They gave back what they kind of gave away, and then got some price potential from the idea that the Fed would stop raising rates. And I think 24 is the year where you're going to start actually seeing some of these things and themes that we've talked about, like generative AI, start to monetize. So instead of this being a creator society of chatbots and kind of stylistic AI types of things, I think AI is going to start enabling different industries to benefit their bottom lines, cut costs, become more efficient. And I think that's really what drives tech forward. And tech means cloud, cybersecurity. It means AI. It means chips. It means, these companies like Apple, Microsoft, and Google, who just have also on top of that very steady balance sheets and are good long-term holds.
We did see the tech-heavy NASDAQ 100 dropping for a fifth day. This is, I think, the longest losing streak since December of 2022. Are there stocks within that cohort that you would be avoiding? And I guess specifically, where would you be adding to allocations every time we see this pullback?
Yeah, so it depends on the type of investor. And I think if you're looking for a broad-based allocation, you could look to an AI type of fund. You could look to a quantum type of fund. You could look to a Mag 7 type of fund that gives you exposure, or even just Qs, buy a NASDAQ type of fund. In terms of single name stocks, I think my picks for this year are going to look something like Google, Amazon, IBM will be on that list as well. Palo Alto will be on that list. And the reason I like Google and IBM is I think that they're I think Google's really going to pick up in the AI space and monetizing there, particularly with their Gemini reveal, their abilities in cloud. And then for IBM and Google, they have this focus on quantum computing, which is going to be, a growing field. There's billions of dollars of government spending going into that. And in order for AI to work efficiently, in order for the data to be processed, you need speed in computing. And I think, I want to sort of allocate to the names that haven't led the race.
Sylvia, you've got a bit when it comes to positivity on Amazon, and part of it is to do with AI in the cloud. But I think it also speaks to what I perceive to be some optimism for the consumer this year.
Yeah, and that's a great point. And you each discussed a little bit earlier in terms of some of the data that has come out recently. So we see that wages remain strong and jobs remain healthy. While that might be confusing in terms of when the Fed actually starts to cut, I think that overall it's a good sign that the economy is holding up. And if the economy is holding up, that means the consumer and consumer spending is holding up. And so Amazon touches just about everything for me. I think that they were sort of trying to find their footing post Bezos and had a lot of supply chain inefficiencies, things like this. And so now you have online shopping, right? And the consumer continuing to spend. They're going into the drug space. They're going into the food space. They touch quantum computing. They have IonQ offering utility quantum computing through Bracket. They have a cloud product. And as we know, cloud and cybersecurity have a 20% projected compounded annual growth rate through 2030 because of the growth of AI. So I just think that Amazon, again, it's sort of one of the stocks that didn't perform as well as the other Mag 7 over the last few years. I think that they're going to, along with Google, end up, being winners here this year.
Sylvia, if you take a look at market expectations on what the Fed does, there's pricing of over 5 cuts this year. If that doesn't materialise, or if the economy weakens more than expected, how do you think that plays out for the growth sensitive and the rate sensitive stocks?
Yeah, that's a great question. And the markets have become just so interesting because it seems like when, all the ducks are kind of in a row and the Fed is going to stop and then we're going to get rate cuts, everything is good. You get a geopolitical issue, you get kind of a shock in an inflation number, manufacturing number, things like this. But overall, my view is that this is actually going to be a fairly stable year in terms of how it ends. I think it'll be an annualized average return for S&P 500, 10, 12%, something along those lines. It's an election year and incumbents running. The last 16 times that happened, the market was up. And I think that whether the Fed cuts 4 times or 5 times, until then, it's going to be choppy and we'll all be kind of, talking about soft landing. Does this happen again? Are rates going to be high for too long? But then at that first cut, I think that growth stocks take off. It's just sort of behavioral from what we've seen in the past in terms of what happens when Fed Chair Powell talks about a rate cut.
Sylvia, always great to chat with you. Sylvia Jablonski, CEO and CIO at Defiance ETFs. Well, the St. Louis Fed has appointed the former New York Fed executive Alberto Misalem as president. He's assuming the post on April 2nd, replacing James Bullard, who's stepping down to become dean of Purdue University Business School. Misalem will become the first Hispanic policymaker to lead a regional Fed bank. More recently, he served as a CEO of Events Asset Management, a quantitative hedge fund founded by billionaire Paul Tudor Jones. Well, still ahead, we'll check in on energy markets as rising US gasoline stockpiles signal shaky demand despite tensions in the Middle East, Red Sea and Libya. We'll get the latest next. This is Bloomberg. Islamic State is claiming responsibility for Wednesday's deadly bombings in Iran that are threatening to further inflame tensions in the Middle East. It's bringing in Bloomberg's Michael Heath. And Mike, we spoke about this yesterday as being, you'd mentioned that the sort of likelihood scenario.
Yeah, I don't think it's much of a surprise that it was Islamic State. It was such an indiscriminate attack, whereas when when these are state-based operations, they tend to be much more precise, as we sort of saw a little bit earlier in Beirut in Lebanon with the killing of a senior Hamas official that's been attributed to Israel. But nonetheless, I mean, it does inflame tensions. I mean, there's all sorts of amazing stuff going on now where there was a state media report coming out of Iran that Israel runs Islamic State, which is obviously not nonsense. But yeah, look, it's a very tense situation there, and these problems are just mushrooming up across the region. I mean, really, we're looking at from Lebanon to the Red Sea. There are issues everywhere. We've obviously got Secretary of State Blinken coming to the region too, and he's going to have a tough task ahead.
How big is the risk being posed by the fact that we are seeing these Iran-backed proxy efforts, and as you say, in the Red Sea and across other parts of the region as well? Does this widen the conflict? Yeah,
well, I mean, it's certainly an issue for Israel, and this is what the US has been trying to sort of navigate through as well, is to limit this conflict to Israel versus Hamas kind of thing. But Iraq calls that area the Arc of Resistance, and it sponsors Hezbollah in southern Lebanon, which is on Israel's border, and that's a significant issue too. I mean, the Israelis have sort of signalled that they want something done about Hezbollah, which is a powerful organisation, has a lot of missiles and rockets. Israel fought a war with Hezbollah in 2006, and they want to sort of deal with that issue now. Excuse me. Now, while Hamas, once Hamas is, excuse me, has been removed, and so there is this sort of arc of groups, and that's what Secretary Blinken will be trying to do is ask regional states to put pressure on Iran, to put pressure on these other groups to refrain from widening this conflict, because it really could spiral out of control quite easily.
As has been suggested, they don't expect every conversation on this trip to be easy in that prelude to Secretary Blinken's trip. Michael Heath here in Sydney. Well, the US says Russia used missiles. As we get the latest on this story from North Korea in attacks on Ukraine in recent weeks, according to newly declassified intelligence. White House spokesman John Kirby says Russia used the weapons in at least 2 attacks on December 30th and January 2nd. Kirby says Russia plans to keep using the North Korean missiles and is also looking to acquire more weapons from Iran.
We assess that Russia intends to purchase missile systems from Iran. The most effective response to Russia's horrific violence against the Ukrainian people is to continue to provide Ukraine with vital air defense capabilities and other types of military equipment. To do that, we need Congress to approve our supplemental funding request for Ukraine without delay.
All the latest geopolitical events are adding volatility to oil trading. Fresh evidence of a surge in U.S. supplies has added to bearish sentiment. Bloomberg's Sue Keenan joins us now with the latest. And Sue, we're seeing these rising gasoline inventories here.
A massive build, in fact, the biggest in several decades, at the same time where the one-week implied demand here in the U.S. is actually at a low for the year. And that has a lot to do with the fact that we've got a snowstorm hitting the East Coast, and there are projections that will reduce a lot of people using their cars, and therefore retailers will work through demand. So what we've got is crude supplies, more of a mixed picture, but all of this, again, depressive on oil in the U.S. session. We are seeing a slight uptick in Asia trading. West Texas Intermediate up by about 1/3%. But while the Mideast tensions and shutdowns in Libya's oil production had created volatility, as Shery mentioned, the real focus seems to be on the issue and concern about oversupply. The gasoline data, gasoline futures falling as much as 3 1/3% at one point in U.S. trading before paring those losses. Very telling. Analysts explain that despite the substantial drawdown in crude supplies nationwide, we did see a buildup in the supply hub in Oklahoma. The buildup in gas and distillate stockpiles, these are the products of crude oil, really taking precedent and bringing to light that fuel demand once again stalling out. And that is a key thesis for the bears at this point.
Meanwhile, Wall Street analysts are scrambling to cut oil price forecasts for the year. So what are we hearing in terms of the outlook?
Well, it's a worrisome message in terms of the direction of oil prices. What we know is Bloomberg surveyed 5 major Wall Street banks, and only one of them, Bank of America, actually sees gains for oils in 2024. Morgan Stanley cut their outlook for Brent crude by 9%, following in the footsteps of Goldman and UBS. And you're looking at what is some of the key themes going forward: a renewed focus on geopolitics, as we just heard, in the Mideast, the Red Sea, and now Libya is actually seeing some of its oil production taken down. So that shows a potential to reinduce a conflict premium. But the overarching concern appears to be the rising production from non-OPEC plus sources, such as the U.S., and the potential for this to outstrip demand. That's why there's concern about this latest data in the U.S. There's concern about whether there will be a rebound in the China economy. And there's also questions about OPEC Plus's ability to bolster oil prices. That appears to be facing a challenge at this point. So Morgan Stanley analysts now expect, quote, a relatively precarious balance in 2024. They again cut their average price target for 2024 by about 9%. Citigroup remains the most bearish, predicting an average of about $75 a barrel for Brent. And Bloomberg Intelligence's Mike McGlone says that when it comes to West Texas Intermediate, the deflationary impact of the next $20 move means it's far more likely West Texas Intermediate will move to $50 rather than $90. He points out West Texas Intermediate failed to make it much above $90 in 2023, despite some bullish pressures on oil. And there are also concerns about potential recession. That's still a possibility going forward.
Bloomberg Sue Keenan here with the latest on everything that's affecting the oil price right now. WTI at $72.31. You can get a roundup of all of the stories that you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to Daybreak Go, also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg. Treasury futures not doing much in the Asian session after we saw a sell-off here in New York. The 10-year yield rising to almost 4% after we got some resilient data. ADP report showing that U.S. firms ramped up hiring in December. Jobless claims coming in below estimates. This, of course, ahead of the non-farm payrolls on Friday. But really, it's about the global bond space, right, which is now on a 4-day skid. We are talking about bonds and gilts also falling after that upward revision to PMIs. We are expecting European inflation numbers as well, and really trying to gauge where central banks go from here if they have room to start lowering interest rates. Of course, we have already seen here in the U.S. services PMI for December also being revised upwards, so that solid data really being felt across the bond space. The latest corporate stories that we're tracking right now. Bloomberg also learning that Bridgewater Associates' flagship hedge fund lost 7.6% last year. The entire drop came in the last 2 months of 2023, reversing what had been a 7.5% gain through October. The losses for the world's biggest hedge fund corresponded with the biggest 2-day month gain in global bonds since at least 1990. Growing concern over iPhone sales has triggered the second analyst downgrade this week on Apple stock. Piper Sandler's Harsh Kumar lowered his recommendation to neutral from overweight after holding a bullish view since March 2020. He attributes the cut to a weak macro environment in China. Kumar's downgrade follows an even more bearish move by Barclays. We have plenty more to come on Daybreak Asia. This is Bloomberg.
There is a possibility the stock price to fall to around 31,000 yen in January. but I believe it will hit the 40,000 level towards September this year, considering U.S. rate hikes around that time.
I believe the Nikkei will surpass the 38,915 yen recorded on February 1989 before the bubble burst.
I think we may see the stock markets touching 40,000 yen, possibly hitting the record high since the end of the bubble era. We expect overall markets to move steadily, ending the year around 38,000 yen.
Despite the optimism that you've heard from executives there, we actually saw the Nikkei seeing its worst day in 2 weeks. At the first trading day of the year, we had airlines falling and leading the losses, given that, of course, we had those flight cancellations after that collision between Japan Airlines and a Coast Guard plane. Right now, futures are pointing to the upside of 0.25%, while the Japanese yen is holding steady, but really weakening against the U.S. dollar for most of the week. There's more speculation now that it'll be harder for the Bank of Japan to abolish negative interest rates given the earthquake that hit the country on New Year's Day. Rescue personnel in Japan still carrying out last-ditch efforts to find any survivors still trapped in the rubble. Let's get the latest from Bloomberg's East Asia government editor John Herskovitz, who's in Tokyo. John, so what do we know?
At this point, the death toll keeps mounting. There are more and more personnel who are being moved to the area. Military personnel. We have police, fire responders, emergency personnel from across the country who are taking these last-ditch efforts to try to find people. There was a report this morning about a woman in her 80s who was pulled from the rubble after about 3 days being trapped. The government has sees a 72-hour window from the time of the quake as the best time, the most urgent time to get for the rescue operations. They're going on at full tilt, and they're getting up to the edge of the point where they're looking and they can reasonably find, they think that it's reasonable to find people who are still alive in the quake.
John, we've seen significant impact on infrastructure disruptions, of course. Do we know anything about what the estimated economic costs will be from this disaster?
We've seen some estimates that have come out. A loss of maybe like $5 or $6 billion US from this, but the area, Noto Peninsula, where this took place, is not a home to a lot of industry. It's not heavily populated, but the earthquake was powerful. It hit a broad area, and there are companies which have factories, manufacturing facilities in nearby prefectures, which are checking operations, they're checking supply chain disruptions, but the toll for the people on the ground is just enormous. You're seeing the pictures now of the devastation, and people have lost everything. There's still about 30,000 or so residences without power. People are trying to get food, water, shelter. The temperatures are cold, it's raining, there's a chance of landslides. So the economic impact for the economy is significant, but it's not as big as some of the other natural disasters. But the human toll is just enormous for the people who are affected.
Bloomberg's East Asia government editor John Herskovitz there in Tokyo. An international team of investigators is combing through the wreckage in the meantime of the two aircraft that collided at Tokyo's Haneda airport. They're hoping that the voice and data recorders from the JAL Airbus could provide clues about the final moments before impact. The cockpit voice recorder from the smaller Coast Guard plane has also been recovered. Pressure is building to find out exactly how the two aircraft ended up on the same runway at one of the world's busiest commercial airports. We're also watching the yen in the session under pressure. Banks repricing their bets for when the BOJ will end its negative rates regime. Let's bring Bloomberg's chief rates correspondent for Asia and MLive contributor Garfield Reynolds. And Garf, we're seeing traders really the least bullish on the yen since what, about August? Is there more room for further weakness?
At least in the short term, yes. It was always a little bit. It was one of those puzzles about some of those year-end moves that became so extreme across a lot of assets, and all of that combined very much, when it came to the yen, the expectation that the Fed would be cutting rates rapidly and that the BOJ would be moving fairly rapidly to end negative rates. Those two factors combined, to set off a very strong move in the yen, and we've had pullbacks on both those sides. In the case of, on the Japanese side of things, the earthquake concerns about disruptions to the economy have spurred some speculation that this will make it less likely that Ueda moves as early as this month's meeting. That has always seemed to be a little bit of an outlier. A lot of interest had been more in March, April, that sort of timetable, and the earthquake and the uncertainty there has helped to reinforce the idea that Ueda, who so far, and of course very early in his tenure really, but so far he's shown a lot of signs of being a gradualist, wanting to be very cautious about the moves that he makes, that this will just add to the reason for him to be cautious. The other thing, of course, for the yen is that the unwinding of some, or the paring back of some of those very aggressive bets on interest rate cuts from the Fed this year, that's obviously dollar supportive. There's a general feeling that the dollar sell-off at the end of last year went a bit too far too fast, along with a lot of other moves. So add those two things in together, and it's certainly until you get something that brings back that zeitgeist that 2024 is the year when the Bank of Japan hikes and the Fed cuts, and that both of them go fairly rapidly towards it, till you get a restoration of that your consensus, you're unlikely to get strong gains for the yen.
But that seems to be an inevitable outcome, isn't it? I mean, it's not a matter of if we get a stronger yen, it seems to be a matter of when.
Oh, well, very much so. However cautious he may be about the end game, BOJ Governor Ueda is fairly clear that the end game is in play. And once the BOJ gets rid of the negative rate, the minus 0.1% target for 2-year yields, once they move to unwind yield curve control and therefore eventually move to reduce buying of government bonds, even if they might have to buy more of them in the short term, that should all be very supportive for the yen. The question is very much about how fast we get there and how strong the yen gets in response to all of that. And one of the concerns that's been rippling through a lot of traders and investors' minds, at least those that are around in this first week of the year, is how rapidly whether we've gone too far. If you've already gone to 140 yen but you think you're going to go to 110, well, that's fine. If you've gone to 140 and you think 130 is more like the sort of medium-term target, well, that gives you a lot less potential profit to play with, and the risk-reward balance shifts more towards risks than rewards.
Have we gone too far when it comes to the global bond sell-off and treasuries, right? There's certainly one massive bearish bet that doesn't think so.
Well, again, this comes down to when the bond rally kicked off in November, that seemed very sensible. We got to 5%. That's like real money, as it were, real retirement level. So wow, 5% yield. When was the last time you saw that? But then as it extended in December, and especially after the Fed pivot, it all seemed to be just a case of FOMO. Everybody was piling in. There were a lot of reasons why people would go into fixed income. So there's definitely a feeling that things went too far, too fast. And in what's still going to be fairly thin trading conditions, there remains a lot of concern that we're vulnerable to, a pullback to a more sane, sort of level. There's one options trade that has caused a lot of buzz overnight, the bet that the yield could jump to 4.15 or 4.2% from about 3.95 or so now. That sounds like a lot. Then again, it would still leave you in that strong downtrend. It underscores the idea that investors are seeing difficulty at the moment for yields to push significantly lower than they got to at the end of last year. So the easier money now looks to be in betting on increased yields.
Bloomberg's chief rates correspondent for Asia and MLive contributor Garfield Reynolds there. And we also heard from DoubleLine Capital, who thinks that Wall Street expectations for the Fed to cut interest rates as early as March is also optimistic. Its deputy CIO, Jeffrey Sherman, told us more about the warning signs that remain in the economy and labor market.
At the end of the day, I think what's happened there is that those risks still are present. And so the thing is, the yield curve is still inverted. This is one of the longest tenures of yield curve inversion when you look at like 2s, 10s, since really back in the early 40s. And so it's really problematic that you see that the market is really fighting the Fed here too. And so the market, the rallies we've seen, what we've been calling the everything rally since November 1st, really just started to really be predicated on rate cuts again. So if the Fed was really tried and true with their higher for longer mantra, I think that we would get closer to the recession. And, you know, when people call for soft landings, usually what that means is that there's some problematic area of the economy. It just doesn't have the breadth across. That's what makes it a hard landing. And so I still think that there are still some challenged areas. But if we start to see some of these rate cuts, maybe some of those problematic areas do get skirted, and the Fed achieves the miracle of being able to really navigate this hiking cycle and be able to normalize policy back without causing pain. The problem is that historically, the Fed has a 100% track record in most of these instances of causing a recession, at least when they stay dedicated to the hiking cycle.
Right, right. Well, interest rates are a very blunt tool when it comes down to it. You mentioned risks. What is the bigger risk right now? A reignition in inflation or a stronger than expected labor market, which is kind of what we're seeing signs of right now?
Yeah, I think the labor market has been relatively strong. I know a lot of people question it, saying, you know, is it the birth-death model? And, you know, we've seen some net revisions negative, but on whole, the labor market has held up pretty resiliently. And when you look at unemployment claims today, the new data coming out, whether it's continuing or initial claims, they're not putting up red flags at this point. And so I don't think that the labor market is going to reignite and you're going to start to see 300,000 and 400,000 jobs per month being created. But I do think that the bigger risk is the inflation. And I think the Fed will have concerns about some of this, which is why we kind of scratch our heads with Jay Powell at the last press conference. You know, in November, he talked about financial conditions being tight, the bond market signaling it, then rates rally, financial conditions ease. Made no mention really of it at the last press conference. But if the Fed does believe in these wealth effects that we heard from Bernanke in 2 administrations ago at the Fed, that ultimately, you know, when people feel wealthier, risk assets rally, their portfolios go up, they spend more, maybe then all of a sudden this starts to cause some concern at the Fed that we start to see this kind of reacceleration of inflation. But at this stage, we see core inflation has been dampening. The trajectory is right, but the market is definitely extrapolating this into that the Fed is going to normalize policy back to a much lower rate. And it just seems that it's a little optimistic today to think that's going to happen so soon as early as March.
DoubleLine Capital Deputy CIO Jeffrey Sherman there with Scarlett Fu. You can watch us live and catch up on some of those past interviews in our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about, plus become part of the conversation. You can send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
You're watching Daybreak Asia. I'm Annabelle Drulers with a check on markets, and one of the focus points over the course of this week has been most certainly what's happening in the Bitcoin space and crypto overall. It has been pretty whipsaw trading. You can see here that action over the past 5 days. Broadly, we are up around 4% over the course of the past 5 sessions, but still that fluctuation really being dominated by these changing perceptions or views that we're hearing from analysts around the expectations for a spot Bitcoin ETF to be approved in the US by the SEC. So the deadline for the first application is January 10, so next week. But there was some media reporting saying or suggesting that it could come as soon as Friday, and that really led to that rally once again overnight. It's not just, of course, the focus on spot Bitcoin ETFs in the US. Of course, that would really lead perhaps to a lot of institutional adoption, but still in Asia as well. If you change on, take a look at what we see, because we already have a futures ETF that's managed by CSOP in Hong Kong. You can take a look at the returns of that since its inception at the end of December 2022, rallying around 150% over that time, which is particularly notable when you think about the moves for the Hang Seng overall, which is down around 23% over that same time period. This could be the market where we see Asia's first spot Bitcoin ETF being approved in Hong Kong. We've already had regulators signaling it could be the case, but certainly, Shery, it really plays into those trading dynamics. Investors really want to see that spot Bitcoin ETF being approved, at least in the US to begin with, to give them more conviction to return back into crypto markets.
Right, Val, let's discuss those expectations as well as the outlook for crypto. With us now is Lucy Guzman-Rarian, founder and managing partner at Token Bay Capital. Lucy, good to have you back. So first of all, what do you expect to happen with Bitcoin ETF? We have heard the likes of some analysts thinking that the applications will fall short of the requirements by the FCC.
I mean, I think overall the expectation is almost at 90% that we are going to get an approval next week. But of course, there is room for that not to happen, right? And it doesn't get approved. We did have one analyst say that in Asia, and that just led to a sell-off of Bitcoin around the world. It's very jittery with these expectations. There's really laser focus on Bitcoin's price right now. So it's always been a volatile asset, but I think there's so much focus on the price right now that it can make it move even more, jump around even more than it usually does.
That's sort of exactly one of the reasons why regulators have been hesitant about these products, right? I mean, that ordinary investors might not be able to stomach all of that volatility, not to mention the potential for market manipulation. So what's changed?
I think that's exactly right. I mean, it's going to be, I think, very interesting to see what's in the disclosures, what's in the small print for investors to read before they go ahead and invest in these types of products, because the volatility is really extreme. And that's been a characteristic of Bitcoin right from its inception. I think we have to remember that Bitcoin is still only 15 years old. It's a very new asset, and it's really the lead asset in an entirely new emerging asset class of cryptos in, more generally. And so this volatility, it's a characteristic, it's a feature, it's not a bug, and it's got to be something that investors are informed about so that they know how to place it and invest in it and have it as part of their asset allocation. Treat it in the way that it's supposed to be treated, which at the moment advisors are saying have a very small part of your overall portfolio in a volatile asset like Bitcoin. Because while the upside is very appealing, and we've obviously seen historic returns coming from Bitcoin as an asset class, the drawdowns can be particularly painful. So as always with investors, looking at investment time frame and looking at your overall asset allocation when it comes to Bitcoin.
The reason that we had this tear on crypto assets leading up to this announcement by the SEC is the expectation that we'll get a new wave of investors, of different sets of investors having access to cryptocurrencies, right? Tell us a little bit about how mainstream these crypto tokens have become and how much of a game changer this ETF would be.
So to date, really what we've seen with Bitcoin and more broadly in the crypto space and industry is it's really been retail driven. So it's bottom up, it's retail driven. That's how Bitcoin came to be in the world, actually. It's through bottom up organic growth. It wasn't the institutions coming in. It was not top down. So what we are likely to see with a Bitcoin ETF is continued retail flows, because ETFs make that far more accessible. I think the sticking point with a lot of retail investors when it comes to Bitcoin and cryptos in general is how to access it. Retail investors are not familiar with the crypto exchanges, how to onboard onto these new financial institutions. It's not broadly available in brokerage accounts, and that's about to change. So it's going to become much easier for retail, but the big shift that we're likely to see with this ETF is the passive institutional flows that can now start moving into this asset class. And they may move into Bitcoin as a standalone investment, or it's part of the overall asset allocation for any institutional portfolio. So that's really going to move the needle. And that's why everyone's getting so excited at this moment, because it's this upcoming era of institutionalized crypto.
We're also seeing activity picking up around stable coins being issued by traditional financial firms, right? What role are stable coins playing in bridging the gap between crypto and traditional firms?
So stablecoins are definitely one of the sort of winning use cases of crypto, and they're typically tethered or backed one-to-one with a fiat currency, the most common of which is the US dollar. And what we're seeing with stablecoins, that there can be a whole array of different stablecoin issuers. It's not limited to banks, but actually we see crypto exchanges issuing stablecoins, and we're even seeing corporates like PayPal issue stablecoins. So this technology is actually making it very easy to create, for the private sector to create money. So now the task for regulators around the world is, how are they going to manage this? How are they going to regulate this? Who are they going to give a license to for them to be a stablecoin issuer? And that's definitely a hot topic in Hong Kong, but across Asia, you know, there's this belief that stablecoins are actually a very useful tool. And indeed, they do bridge crypto markets with the traditional markets. And so let's see, for example, what Hong Kong's going to come out with, because at the moment they've got a consultation paper out to ask the industry what they think, how stablecoins should be regulated, and also how to position stablecoins vis-a-vis the central bank digital currencies, which are also coming down the pipe.
Yeah, we'll be looking forward to that outcome. Lucy Gasmararian, good to have you with us, founder and managing partner at Token Bay Capital. We have more to come on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. Top corporate stories that we're following this hour. The maker of Wilson tennis rackets, Amer Sports, has filed to go public in the US. It's targeting an IPO of more than $1 billion, and sources say the listing could lead to a valuation of $10 billion. The company is backed by China's Anta Sports, and Greater China drove nearly 1/5 of its revenue growth in the first 9 months of the year. Tencent bought back a record $1.3 billion of shares in December, accelerating the pace after new gaming regulations rocked Chinese markets. It boosted daily purchases after the shock December 22nd announcement triggered a broad tech sell-off. Tencent has spent over $380 million on buybacks in this week alone. We'll take a look at how we're tracking as we end what has been a decidedly risk-off week. We're seeing a little bit of a clawback there and a mixed picture for markets that are online at this point in time. We're, of course, just a few minutes away from the start of trading in Seoul and Tokyo. Sydney stocks just modestly higher, about 0.1% there. We're expecting really that muted picture to continue as Japanese and Korean markets come online in the next few minutes. This is Bloomberg.
This is Daybreak Asia. We're counting down to Asia's major market opens. As the global bond sell-off continues, we had the 10-year yield around 4%. Of course, we had more eco data showing resilience in the U.S. economy ahead of the Friday's non-farm payrolls numbers.
Yeah, so much uncertainty as to what that means for the Fed's path, right? We're seeing quite a bit of repricing in that aspect as well. But, Belle, here in Asia, we're looking like that mixed end to what has been a challenging week continuing.
Yeah, probably not the first week to trading that really investors wanted to see for 2024, but certainly it has been that big focus, that key concentration on where the Fed goes next. And as you said, it's those signals of a resilient labour market that are telling us that we're going to need to see rates perhaps staying higher for longer, and that that really wasn't the dynamic that was priced in perhaps at the end of last year. But the setup today is again going to be dominated by that theme. And at the start of the day, we're just continuing to track the moves that we're seeing in Treasury yields in particular. That's the reopen for cash Treasuries there, and the 10-year yield hovering around that 4% mark. And we are just generally seeing yields rising around the region today. That's certainly also been playing into the dynamic for the Japanese yen. You can see it quite close now to that 145 mark. It has seen about a slide of 2.5% over the course of this week. Not just, of course, there is the dollar dynamic playing into it. It's also the story of the Japanese yen, because traders are perhaps saying that the BOJ is unlikely to shift away from its negative policy settings perhaps as soon as having been priced in, given the ramifications from the earthquake on January 1st. The outlook for stocks today, actually the Nikkei 225 is rising here, which is looking to be one of the brighter spots for Asian equities trading, perhaps taking a little bit of advantage of that weaker yen story as well. Let's change now, see what's happening in Korea at the start. We are again keeping an eye on what's happening in FX markets here, and it is still that story of Korean won weakness, now trading quite far past that 1300 mark. It is down around 2%, the Korean won versus the greenback over the past 5 sessions. Stocks-wise, we're also keeping an eye on what's happening in the tech space in particular, given the moves that we had in the NASDAQ overnight, dropping for a 5th straight day. That's the worst showing we've actually seen for US tech stocks going back to November, or December rather, of 2022. So it's just really a signal as well, selling pressure, given we did see that huge run up in the so-called Magnificent Seven over the course of last year. Turning now to what we're seeing in the Aussie session so far, 1 hour into trade, and it is that story of lower trading volume. Still a lot of people away for the Christmas New Year break, and so you're seeing the ASX 200 barely budging there, but continuing to track the moves that you see in WTI. Oil did drop yesterday in the session, sort of stabilizing so far, but the focus very much on rising gasoline stockpiles in the US, and that really signals perhaps a bit of a shakier picture, Heidi, for demand.
Val, let's bring in for some views. Herman Lee, who's a senior macro strategist at Lombard Odier, joins us. Herman, great to have you with us. And as you say, we've gone from the TINA trade, there is no alternative, to there are many other alternatives, right, at least as you see it. And a lot of them are in the bond, fixed income and credit space. Herman, if you take a look at the global bond turmoil that we've seen this week, what does that tell you about, how selective you are within that space?
Well, the normalization of bond markets valuation to the long-term fundamentals, wasn't going to be a straight line. So we see this week's episode as more of a calibration, a temporary calibration. So our medium-term view on bonds, is still quite constructive, especially for the conservative investors. If you think about bonds valuation relative to the risk assets, which have rallied quite a bit, especially in the last few years. Now you have a genuine yield, and we say that even accounting for a bit of a relief rally for the bonds in the latter half of last year. So it makes sense, after this significant rally, especially for the conservative investors, to lock in some of these yields in their portfolios, and at least buy some investment-grade credit. So we think these are still good ideas for these investors, and certainly we still believe at the start of the year that it's good to have these assets in a diversified portfolio.
Do you see a haven in Chinese bonds? There is widespread expectation that even amidst a global sell-off, and of course China is, in terms of policy, the economic trajectory, an outlier in so many ways, that bond market will be able to withstand that sell-off.
So for international investors, it's still a complex market, because you don't have a fully open capital account here, even though the authorities have been making efforts to open the markets more to the international investors over the last few years. Certainly the macro situation in China is challenging, so that's supportive for the asset class. But in thinking about the suitability for the investors now at this point, especially after this rally, it's not as appealing. So for local investors, certainly it might have a place for their portfolios, but the international investors still need to think about the fundamentals and their potential impact on the currency as well, which is an important dimension for them. So we would argue that it's a tactical trading opportunity for international investors, and it's more difficult to make the argument that it should be a part of a strategic asset allocation.
And that's for equities as well, right? Chinese equities, which just cannot catch a break. Given what seems to be constraints or restraint on the part of Chinese policymakers on how to support the economy, do you see any opportunities that are compelling this year?
Well, the country has been coping with the long-term challenges, and they are very clear to the international investors. The least thing that the policymakers can do is to ensure that the economy, is avoiding, risk of a long-term deflation, and that's still the risk that we're dealing with. I mean, if you look at the volume of activities is okay. We just looked at the decent release for the service PMI for China, so there is growth in the country, but on the inflation front, it's still very low, and that's indicative of deleveraging that's still going on for the private sector and a very pessimistic outlook in the private sector. So the authorities need to tackle this more convincingly. Now, as you mentioned, there are constraints that the authorities have imposed on themselves. We understand the reasons for this. For instance, the pledge for renminbi stability, which would be slightly inconsistent with the reflation efforts. The delay in reform measures for the urban planning, which we would argue is actually also important for the cyclical policy decisions, because the pledged supplementary lending and these efforts, they need a clearer view for the medium-term development in Tier 1 cities. So we are not getting these signals, probably because these are complex topics for the authorities. But last year was probably a good window to announce all these measures. Unfortunately, we have not gotten these signals yet. So because of this constraint, the reflation efforts will face a bit of resistance, and as a result, for the international investors, it's a very difficult market to get into, and we've been reducing, Chinese equity exposure in favor of the other markets over the course of last year.
Yeah. Do those other markets still include Japan this year? Because you see an end to negative rates by April.
So for the medium term, we are constructive on Japanese economy and financial markets. We do think that the country is positioned very well for this friendshoring trend for the global economy. But for the very near term, there is that currency dimension. Now, in the very near term, we think it's going to be a bit of muddle because, as you have mentioned, we're dealing with a bit of a sign that the U.S. economy is slightly more resilient than what we expected, even though we still expect the economy to slow down. So we're coping with the data uncertainty, and the Bank of Japan doesn't seem to be in a hurry to end the negative interest rate, even though we still expect it by the April monetary policy meeting. So in this kind of combination, it's going to be a bit of muddle for the currency market. For the equity markets, we'll probably have the similar outcome. But in the medium to long term, the domestic stocks should perform better, because we still think the fundamentals will start to show up again after a pretty difficult third quarter last year. So, we're still neutral on the Japanese equities, but for the medium term, still constructive.
Hyman, really great to have you with us. Hyman Lee, Senior Macro Strategist at Lombard Odier. Let's get you back to Bell for a look at some of the early movers.
Yeah, we're just taking a look at some auto stocks or really providers of chips and other technology to the automotive industry. Really, you can see here mostly in negative territory this morning. This does follow the moves that we saw in Mobileye overnight. So you can see that plunge there around 25% in the intraday session. That is, of course, the last close for that company. Mobileye, it's actually Israel's most valuable publicly traded company, of course, listed in the US, but it makes semiconductors for driver assistance vehicles or systems in vehicles. And overnight, it put out its full-year revenue forecast. It fell well short of what Wall Street had been expecting. And so that really contributed to that significant plunge there you can see for the stock. Mobileye says that customers are paring back their orders after stockpiling during the pandemic, so it does certainly just flag some concern around the sector and the health of this part of the vehicle sector. So that is the state of play that we're seeing for some of those stocks that do provide, as I said, chips and other technology for the automotive industry, Shery.
Right, Belle. Still ahead. The U.S. jobs report may show strength only in concentrated pockets of the labor market. Our preview of the numbers next. This is Bloomberg.
There is a possibility the stock price to fall to around 31,000 yen in January, but I believe it will hit the 40,000 level towards September this year, considering U.S. rate hikes around that time.
I believe the Nikkei will surpass the 38,915 yen recorded on February 1989 before the bubble burst.
I think we may see the stock markets touching 40,000 yen, possibly hitting the record high since the end of the bubble era. We expect overall markets to move steadily, ending the year around 38,000 yen.
Of course, we're still some ways to go in order to get to those levels at 33,000 when it comes to the Nikkei. And of course, we had a very bad start when it comes to the equity markets in Japan to 2024. Right now, we're seeing a little bit more upside, 0.1% for the Nikkei, 0.3% for the topics. We're talking about real estate financials leading the gains, materials and tech, though in the red at the moment. Of course, the reason we're watching this very closely as well, the levels of the Japanese yen, so important, 144.69, a little bit of weakening against the U.S. dollar. But the trajectory, of course, depends very much on where the Fed goes from here as well. And what we're seeing in terms of economic data is resilience. Bloomberg Economics expecting Friday's U.S. jobs data to show strength, but perhaps only in concentrated pockets of the labor market, with the details revealing perhaps some more weaker underlying fundamentals. So Vonnie is here with a preview of the numbers. So we're still seeing resilience, but perhaps not as strongly as we did in the past year.
There are signs in places such as where Bloomberg Economics sees it. They point out that really there's been wage growth and also jobs growth in two acyclical areas, so government jobs and also healthcare. We saw that sort of confirmed in the ADP report on Thursday, where you saw hospitality and leisure adding employees, you saw government adding employees, and you saw basically service-producing jobs making up the bulk of the numbers. 164,000 jobs added in December, and of those, all but 9,000 of them were in service producing. It was just 9,000 that were in goods producing. So that'll give you an idea. Bloomberg Economics also expects the unemployment rate to go up to 3.9%, which is more than what the median economist in the Bloomberg survey expects. The median economist expects that unemployment rate to tick up to 3.8%. So on the whole, Bloomberg Economics has maybe just a little bit darker of a view of the labor market. And they do point out that a Fed pivot may have stunted recessionary dynamics in the labor market, but that dynamic isn't clear enough yet. As we've been seeing, markets literally since the minutes have been repricing expectations. Will they reprice again starting from Friday at 8:30 a.m. Eastern when those numbers come out? Well, we'll have to see. As you pointed out, Shery, several data points today showed that there is resilience in the labor market. So we had initial jobless claims. They were lower than anticipated. The ADP report showed growth. The JOLTS data showed less turnover in the labor market, and that was on Wednesday. And then we also had Challenger Gray and Christmas data, which we also watch very closely, and that suggested any labor market cooling is largely coming in the form of weaker hiring as opposed to layoffs.
What are the wage growth estimates suggesting at this point?
Well, it's interesting, Heidi. We will get wage data, and it will show cooling, just like ADP showed today, according to most economists. So ADP showed that people who stayed in their jobs saw wage growth of 5.9%. People who moved jobs saw wage growth of 8%. Sounds like a lot, but take out inflation. And it's anticipated that tomorrow we will see wage growth month over month of 0.3%, year over year of 3.9%. Now, that's still extremely strong, and bear in mind, we've been in that range of growth of 0.2 to 0.4% since August of 2022. So that's 18 months of really strong wage growth. So we'll see if that comes down. The Fed will also be looking at that very closely, because that will suggest what it needs to do about inflation dynamics and whether inflation is coming down just as much as it's optimistically suggesting right now. The other data point that will tell us a lot about that is the ECI, the Employment Cost Index, which comes out quarterly and actually comes out when the Fed begins to meet again, January 31st. So perhaps that will be the better indicator of how wages are moving along here in the United States and how they moved at the end of last year.
Hi, Bloomberg's Fonnie Quinn here with the latest on what to expect from the Friday's non-farm payrolls report. The St. Louis Fed has appointed former New York Fed Executive Alberto Mussolem as president, is assuming the post on April 2nd, replacing James Bullard, who's stepping down to become Dean of Purdue University Business School. Mussolem will become the first Hispanic person to lead a regional Fed bank. Most recently, he served as CEO of Vince Asset Management, a quantitative hedge fund founded by billionaire Paul Tudor Jones.
Well, the Islamic State is claiming responsibility for Wednesday's deadly bombings in Iran. It's an attack that threatens to further inflame tensions in the region. Let's bring Bloomberg's Michael Heath. So we did talk about the likelihood of this being the responsible party yesterday.
Yeah, I mean, it was such an indiscriminate attack that it was always unlikely that this was a state-based one. I mean, the assassination that's been attributed to Israel of a senior Hamas commander in Beirut, that's more classic sort of state-oriented killing, where it's the individual they're targeting, and there's limited fallout either side. Whereas this one, it was basically carnage there. What's concerning, what's interesting, is that this has happened in Iran, and Iran is obviously the source of a lot of the financing and support of these various groups that are fighting with Israel. Whether it's Hamas, obviously in Gaza, whether it's Hezbollah in the north of Israel, southern Lebanon, the Houthis who are firing on the ships in the Red Sea. So this whole arc of resistance is supported by Iran, and to have such a high-profile attack in that country, again, it just ratchets up tensions even further, which were already high. I mean, we're just seeing these flashpoints emerging all over the place at the moment.
We're expecting Secretary Blinken to again be in the region. How much is at stake during this trip, and what can be achieved given that it seems tensions in the region are just expanding and escalating?
Yeah, that's right, Shery. I mean, it's his fourth trip since the initial attacks on Israel on October the 7th, and it is going to be a very difficult one. He's going around the region, and there's a lot of angst or anger even there. Obviously, there's been terrible civilian casualties in Gaza caused by Israel's ground campaign, its bombardment. I mean, more than 20,000 civilians killed. So there's a lot of anger there. But by the same token, the US needs to try to apply some pressure or to encourage these states to try to rein in Iran, to try to rein in Hezbollah and the Houthis and these other areas to stop the conflict from widening. I think that's his key goal in the region, is to try to press again to ensure that this remains contained, and with Israel to press them on what does the picture look like for Gaza after this conflict ends.
Bloomberg's Michael Heath there joining us from Sydney. And of course, we have seen those escalating tensions around Israel and Gaza really spreading to the Red Sea. Skirmishes around the Red Sea now forcing ships to take an alternative route around Africa that's driving up container shipping rates. This chart showing rates from Shanghai to the US and Europe have surged since the attacks, and that could add to inflation pressure globally. Still, Bloomberg Intelligence argues that these costs remain below the 2021 peak and tend to have limited inflationary effect. Now, the latest geopolitical events adding volatility to oil trading. Still, we're seeing fresh evidence of a surge in U.S. supplies, and that's actually added to bearish sentiment. Bloomberg's Sue Keenan joins us now with the latest. And Sue, we're seeing those rising gasoline inventories here in the U.S.
Yeah, it was a massive buildup in the latest inventory data, which was delayed a day because of the New Year's holiday. What it showed was the largest one-week build in gasoline supplies in 3 decades and an implied 1 week demand decline that was biggest in the year. That's partly because we're expecting a big snowstorm on the East Coast, and that could limit people using their cars and therefore needing gasoline. You're seeing oil drop significantly because of the geopolitical events and some of the pressures having to do with the oil data. But at the end of the day, just slightly lower. We're seeing a slight increase in Asia trading. But again, this theme of oversupply remains the large theme, even though there's some shutdowns in Libya's oil production, which are putting a dent in supply. Gasoline futures fell as much as 3.5% at one point before paring the losses. One analyst explains that despite the substantial drawdown in crude supplies, we did see a mixed picture with crude data. Supplies really rose at a key storage hub in Cushing, Oklahoma. That's what traders follow, but we're down across the nation. It is the buildup in gas and distillate stockpiles, the products of crude oil, that really is taking precedence and getting all the focus of traders and bringing to light that fuel demand once again stalling out. That was a dramatic drop in that implied demand figure that really seemed to drive a lot of the late day trading.
So Wall Street analysts are scrambling to cut price forecasts for crude, right? What is that telling us about the outlook for the year?
Well, it's a worrisome message to any of the oil bulls out there. Morgan Stanley cut its outlook for Brent crude for the year by about 9%. That's a major reduction. They follow Goldman and UBS in making revisions. And a Bloomberg survey of 5 big Wall Street banks shows that only one, Bank of America, is forecasting significant oil price gains in 2024. You're looking at the key themes that analysts are stating. While there is a renewed focus on geopolitics in the Mideast, the Red Sea, and now Libya, showing a potential to reintroduce a conflict premium for oil, that overarching concern appears to be the rising production of non-OPEC sources, including the U.S., and the potential for this to outstrip demand. There's concern now about U.S. waning demand. There's concern about China, the rebound that was expected just not playing out. And there are questions about OPEC Plus's ability to bolster oil prices. They face a lot of challenges as we go into 2024. Morgan Stanley analysts now expect, quote, a relatively precarious balance in 2024. Citigroup remains the most bearish of the banks, predicting an average of about $75 price for Brent. And Bloomberg Intelligence Mike McGlone says for West Texas Intermediate, we could go $50 or lower in the next $20 move. Back to you.
Bloomberg Sue Keenan there. We do have more to come here on Daybreak Asia. This is Bloomberg.
We saw that global bond sell-off overnight with Treasury yields spiking on the Wall Street session. Right now, we're seeing a little bit of a reversal in the Asian session with the 10-year yield below that 4% level. But this, of course, after we saw also bonds and gilts falling after an upward revision to PMIs. We are expecting European inflation numbers. Again, we already had U.S. economic numbers showing resilience. We're headed to Friday's non-farm payrolls as well. We have more to come on Daybreak Asia. This is Bloomberg. Breaking news out of Japan, we're getting the Jibun Bank Japan PMI numbers. It's a revision to the downside for the final data point for the month of December. The PMI composite at 50, coming down from 50.4, still barely in expansion territory. The PMI services numbers at 51.5 instead of 52, so that's also being revised downwards, which is really an interesting contrast to what we've seen here in the U.S. and Europe, where PMI numbers have been actually revised upwards. But we'll continue to follow the latest developments, especially as we're seeing big moves in the Japanese markets. Belle, what are you seeing right now?
Yeah, well, Shery, the direction for Asian equities this Friday is really being set by the expectations around the Fed and the action that we saw on Wall Street overnight, because it's been a pretty weak start to the year, no matter which way you look at it, for stocks and bonds. And it really does come down to that resiliency we're continuing to see in the US labor market, telling us that the Fed is likely to keep rates higher for longer. And so that's the dynamic we're seeing across the bond space this morning. You had Treasury 10-year yields just touching that 4% mark overnight, holding fairly steady to that this morning, but still it's that move higher for yields as well in Asia this morning. That's putting pressure, of course, on currencies in turn, and you're seeing those weakness here against the greenback this morning, and also playing out in the dynamics that we see in the commodity space. For instance, the likes of iron ore down 1%, but still hovering, of course, around that 140 mark, so historically elevated levels. Equities-wise, fairly steady. Really, that would be the key takeaway from here this morning. Not really seeing too much movement so far, but of course, there's that seasonality factor to it, with a lot of traders still away for holidays. I mentioned, of course, the labour market, and that focus is very much coming down to what we get out of the non-farm payrolls data on Friday in the US. Let's bring up and take a look at the expectations for that, because in December, we're estimated to see a slip in the number of jobs that were added. Bloomberg Economics, they're actually saying that the non-farm payrolls report likely will show strength only in concentrated parts of the labour market, but the details still to reveal some weak underlying fundamentals. Of course, Heidi's that's that question. When you have good news or bad news, what does that signal for equities? Again, it's just really always those changing perceptions.
Well, we're also watching, of course, the 4-day slide when it comes to global government bonds, right? China, though, emerging as perhaps a surprising hedge. The 10-year yield for Chinese government bonds touching the lowest levels since 2020. It's also helping make Chinese stocks look more attractive. Let's get more from our markets co-anchor David Inglis in Hong Kong. I mean, at what point we'll take anything that makes Chinese stocks look more attractive, right? But are we likely to see a repeat of the record inflows when it comes to China bonds?
I don't know. I don't know. And, you know, we've been trying to, we've been building, you know, I have actually a very long list that's in my drawer of just reasons that maybe you should be buying this Chinese market, right? Valuations, flows, policy, intention. And now, to your point, the global bond rally that's, the bond drought that's taking place, and really the CGBs within that bond drought standing out as the sort of refuge, if you will, really going against the grain because of just how different China is in the cycle, right? So there's reversal of yields pushing higher, and the 10-year yield in China actually now at the 2020 low, and that's really, we'll get to that chart in just a moment there, making this group a lot more attractive than simply just looking at this group purely itself. Now, at least for today, CSI 300, as you can see, the downtrend is still quite strong here. We hit our heads a couple of times on that downtrend. 3283, that was the closing low right before Christmas, which then takes us back to 2018, 2019 levels. So we are approaching that. We're within 1.5%, so effectively a bad day away from, again, hitting that low. So that's the near-term look. The other thing we want to tell you about, too, is, next chart, please, just in context, right? How bad is this current sell-off? And it's bad enough that it's not actually comparable to what we had back in 2015 when the market effectively collapsed, in this case 46% from top to bottom. Currently, if you measure that from the 2021 peak, we're down about 43%. So on price, it's relatively comparable, although that being said, 2015 was a lot quicker. This one was more sustained, three straight years of declines. Now, let's close the loop on that one to Heidi's point earlier on. Next chart shows you, and hat tip, of course, our colleagues at Bloomberg News for this, earnings yield against government bond yields, or risk premium, as they say. So we're actually now at a level where the premium is in favor of stocks. So stocks are now the cheapest to Chinese bonds. We're at fairly extreme levels, and at 0.75, generally speaking 5.5, that typically acts as a buying signal, which the last 5 or 6 cases, Shery, have actually resulted in substantial gains in the equity market. So it is flashing, as the headline suggests here, buying signal. The open is just under an hour away. Of course, Hong Kong, China, and of course the rest of the region, Taiwan, Singapore, and the like. Shery.
Yeah, Bloomberg's evening list there with what to expect from the Chinese Open. And of course, we're watching geopolitical tensions also for any implications for the broader markets. Investors watching the build-up to Taiwan's elections for clues on the path forward for cross-strait relations. And of course, the impact on the global supply chain for semiconductors. Sang-Mi Cha is our Asia stocks reporter and joins us now. Sang-Mi, so let's talk a little bit about Taiwanese stocks here, because we're seeing implications of the outcome of the vote for the broader markets.
That's right. The stakes are high for Taiwan and its stock benchmark TAIEX, as it is trading at almost nearly all-time high. Especially, it has outperformed most of its peers in 2023 amid the artificial intelligence boom and a turnaround in the chip cycle. The strategists and fund managers we talked to tell us that the market has already priced in most of the DPP win, so it's going to look like more of a status quo situation. But a surprise win from the oppositions that are more China-friendly, or a narrow lead of DPP, would mean that it could be a boon for the Taiwanese stocks and the market itself, because that would somehow alleviate the tensions, conflict, and more of that risk sentiment with China.
What would a DPP or KMT win potentially mean specifically when it comes to that crucial chip sector?
Well, Taiwan produces about 90% of the world's most advanced chips. It's definitely a huge market, and especially when it comes to the chip sector, it is very important. It's going to be one of the most crucial agendas for the new administration to forge ties with the U.S., because that will be one of the deciding factors that will allow them to the access to chip-making equipment from the Western providers like the ASML. So a DPP win, as some of the analysts tell us, will be more of a better choice for the sector, for the chip sector at least. That will be because it will be able to enjoy its status as an independent location where you can fabricate chips and assemble the AI servers, whereas a KMT win would mean that some of the companies could shy away from the island and perhaps try to diversify their supply chain. So it is definitely an interesting thing that we should be looking out for, especially given that TSMC makes up more than 27% of the weighting in the TAIEX benchmark.
Sang-Mi, so what about other sectors and perhaps specific stocks that investors should be watching in the run-up to the election?
Well, the energy sector is definitely an interesting industry that the investors are looking at because the presidential candidates they have different policies on this very sector. The DPP presidential candidate would most likely follow the ruling party's policy, which is more of a faster shift to the renewables. They want to phase out the nuclear plant by 2025 and have at least 15% of the energy mix coming from the renewables. So that would be a good news for the wind power companies, which have enjoyed their benefits from the ruling party. Whereas a KMT win would mean that it will be a bit of a slower development and growth drivers for these companies, as they have been pushing for a rather gradual shift to the renewables. We also have the tourism sector that's interesting. There has been several cross-strait restrictions and bans when it comes to mainland tourists coming to Taiwan and the other way around. So that would have some of the impact. The KMT presidential candidate has said he's going to open the doors immediately when he becomes the president. So that would be good news for the tourism and hospitality stocks. And finally, we have some of the defense names that are going to be equally good news if all three of them gets elected. Any of the parties are pushing for bolstering that military capabilities by increasing defense spending, whereas a DPP leader or a DPP presidential candidate is pushing for could potentially be pushing for more of the shipbuilders, as they are looking forward to domestically produced submarines.
Our Asia stocks reporter Sang-Mi Cha there. You can get more on Sang-Mi's story, a stock investor's guide to navigating these presidential elections. And you can get a lot more on the presidential election in Taiwan on Taiwan Decides, a special report featuring Bloomberg's exclusive interviews with all three presidential candidates. You can catch it on Bloomberg TV every Thursday in Asia and Wednesday in the US. It's also available anytime on YouTube. Plenty more to come here on Daybreak Asia. This is Bloomberg.
Take a look at how markets are trading across Asia. Still early in the Asian session, but we're seeing the Nikkei now rebounding 0.25%. And this, of course, coming at a time after Japan saw the worst day in 2 weeks for the first trading session of the year. We continue to watch the level of the Japanese yen at this point to see the direction of some of those big exporters. Right now is to the downside against the greenback to 144.78. The Kospi is also up 0.1%. This, of course, after a lot of volatility this week already, touched a 19-month high earlier in the week, but then we had a risk-off session in the last couple of days. The ASX 200 also slightly higher, while Kiwi stocks are really not doing that much. But of course, there's a lot to digest for investors across Asia. Economic data releases across the region, including the Philippines inflation numbers, CPI readings from Thailand, inflation data in Taiwan, not to mention Hong Kong releases its GDP estimates. India also releasing its GDP estimates. But let's bring in our next guest right now, because she's expecting India to maintain its yearly growth momentum at over 6%. With us now is Radhika Rao, Executive Director and Senior Economist at DBS Bank. Great to have you with us. Of course, we have seen a lot of optimism already about the Indian economy for the past year. What are we going to see in 2024?
Hi, morning. So 2024, certainly, the economy did very well in 23. So if we talk about the fiscal FY24, which India tracks, the growth is likely to be closer to 7%. And I think that numbers, the advanced estimate that's going to be out later on Friday, are going to show those numbers as well. And I think if you will look at the breakdown, under the hood, what you're seeing is that there's a capital investments cycle that's picked up, led by households as well as the government. So you've seen a lot more public sector investments going into particularly sectors like CAPEX, which is again driving, helping to improve trend growth as well. And I think going into 24, we do expect the growth momentum to be strong. I think externally, what you've seen is that, yields have come down, a dollar has weakened somewhat, so that kind of provides a conducive external backdrop. But the one thing that we are watching out for is the demand. As if global growth slows much more, that could be a risk to watch out for. But otherwise, I think India's domestic dynamics and domestic catalysts, I think, are helping to really offset what's happening on the global landscape.
Given what's happening globally, how soon will the RBI need to pivot?
I think the RBI has made it quite clear that, the policy is predominantly driven by domestic considerations. To that effect, when inflation was consistently above their midpoint of their target, RBI continued to tighten policy. Since 2023, now they have, settled rates. So basically, the rates are on hold. But at the same time, to express their anti-inflationary or a price stability stance, they've kept liquidity tight. They've kept interbank rates high. So overall, I think the stance is still pretty much, relatively speaking, still hawkish. So we don't expect them to pivot towards rate cuts too soon. So our base call is that when inflation nears about 4%, which is the midpoint of the target, and our external condition also warrant and change, they would go ahead and cut rates. But we don't see that happening in the first half of 24. It's likely in the second half.
We've seen stability in the Indian rupee. How is that playing into the RBI's calculations?
Certainly, the central bank has been, playing a part. So, currency stability is certainly a part of the mix of the policy mix. What you've seen in the rupee is that it's been very stable. Volatility has been very low. Even in instances when you've seen the broader dollar correct, rupee has maintained the levels it has had, which is about 83, 20, those kind of levels. Now, going into 24, I think what the central bank would be comforted by seeing is, again, a stable currency, a currency that does not display too much volatility. Because at this point, inflationary concerns and geopolitics is something that's ever changing. If you do see another leg up in commodity prices, you really don't want that to aggravate, an inflation problem at home. So a stable currency really works very well. I think they would, again, it allows them space to look at what's happening to inflation, what's happening to the macro environment, and what's happening to global dynamics. So insofar as rupee right now is concerned, I think it plays very much to the comfort of the central bank.
Will we see political stability as well? Polls now suggesting that the Prime Minister Narendra Modi will return to power in elections in April.
India did host about 5 state elections back in November 23. Those results were watched very closely because that was expected to provide an initial glimpse or initial pre-election glimpse of how the ruling party and the coalition is doing. What you did see coming out of those results is that the government actually fared very well, much better than expected in certain states particularly. So that kind of put to rest worries that there could be, political instability, or there could be risks of swing in terms of how the general elections go. That said, state elections don't really give you a very good indications of how the general elections will fare. But nonetheless, heading into it, expectations of political stability have certainly risen. Some of the private sector surveys that are initially coming out are also telling us that. What happens is that the kind of cycle the economy is in terms of cyclical as well as structurally, it helps if there's political stability. The economy is, the manufacturing cycle is taking off quite well. You've got a lot of foreign investors as well as domestic investors who have, in various sectors, be it specialty chemicals, be it electronics, now heading into EVs and semiconductors as well. So political stability provides a very conducive backdrop and certainly ticks the boxes when we're talking about a multi-year, long-term run, at least for the next 5 to 10 years. So I think state elections kind of helped in that direction. We'll wait and see what happens in April and May 2024.
Radhika Rao, good to have you with us, Executive Director and Senior Economist at DBS Bank. This is Bloomberg.
You're watching Daybreak Asia, the latest corporate headlines that we're tracking this hour. And Bloomberg has learnt that Bridgewater Associates' flagship hedge fund lost 7.6% last year. The entire drop came in the last 2 months of 2023, reversing what had been a 7.5% gain through October. The losses for the world's biggest hedge fund corresponded with the biggest 2-month gain in global bonds since at least 1990. Growing concern over iPhone sales has triggered a second analyst downgrade this week on Apple stock. Piper Sandler's Harsh Kumar lowered his recommendation to neutral from overweight after holding a bullish view since March 2020. He attributes the cut to a weak macro environment in China. Kumar's downgrade follows an even more bearish move by Barclays. The maker of Wilson tennis rackets, Ammo Sports, has filed to go public in the US. It's targeting an IPO of more than $1 billion, and sources say the listing could lead to a valuation of $10 billion. The company is backed by China's Anta Sports, and Greater China drove nearly a fifth of its revenue growth in the first 9 months of last year. Tencent bought back a record $1.3 billion of shares in December, accelerating the pace after new gaming regulations rocked Chinese markets. It boosted daily purchases after the shock December 22nd announcement triggered a broad tech sell-off. Tencent has spent over $380 million on buybacks this week alone. Well, we are watching the consumer, tourism, hospitality space very, very closely, right? As we start to get, Shery, both the numbers from the busy, or should have been busy, festive holiday season across China, across New Year's and Christmas, but of course then also going into next month's Lunar New Year celebrations as well. And it hasn't been such a great story when it comes to Hong Kong, right? Bars, a lot of these, iconic venues sitting pretty empty, as we've seen actually Hong Kong residents instead making that trip across the border to the likes of Shenzhen, instead actually going into mainland China as an alternative to a staycation within Hong Kong. So these efforts to revive the ailing retail and hospitality sectors post-COVID increasingly facing these mounting headwinds. The city's top nightlife spots being left pretty deserted as residents choose to go to mainland China for cheaper shopping and entertainment options. You can see in that chart there just the acceleration when it comes to resident outflows in 2023 compared to the blue line in 2019.
And there's really challenges on all fronts for Hong Kong, right? I mean, that weak sentiment translating to also developer demand being dampened. And this is really hurting the Hong Kong government's coffers as well. Of course, we've had high interest rates given the rate hikes coming from the Fed and how, Hong Kong and the Fed's monetary policy are pegged. But we are seeing rising construction costs really deterring builders from acquiring land. So the Hong Kong government is now not going to sell any residential or commercial land plots in the first quarter of this year. There will be a supply of around 11,530 new homes in the financial year ending in March, close to the government's annual target, but it will be the first time in recent years for the government to not sell any residential plots. So this sluggishness in the land market really going to hurt the government coffers. We're talking about that revenue being brought in by those land sales touching only 14% of the annual target.
It's such a reversal of fortunes and kind of just signifies, as you say, Shery, on all fronts how difficult it's been for the government in Hong Kong to try and reset the economy and get it back on track after those harsh restrictions, a lot of the concerns over the national security regulations, the geopolitical concerns, and its sort of ever-growing closeness with Beijing and the impact there when it comes to business sentiment, retail sentiment, consumer sentiment. Right at the peak, we saw Hong Kong seeing more than 5.5 million mainland tourist arrivals. That was back in January 2019, and a lot of big spending amongst them. This is a look across markets as we head into the start of trading in the next hour in Hong Kong, Shanghai and Shenzhen.